Hey everybody, what's going on? I wanted to hop on here and illustrate something very important about this deal. Let me pull up the right screen here. I'm sharing with you. All right. Hopefully everyone can see that. I've had a few conversations with investors where people are confused as to really what conservative underwriting means. And conservative underwriting basically means that we are writing in numbers that protect everyone's capital and allows enough margin for some upside. We feel we've done that, and I can show you exactly why. These numbers here, now this isn't our exact underwriting, but it's pretty darn close. I'm just using this model because it does a good job of illustrating and making it easy. So here are our returns. These are pretty identical to what the deal is projecting. And actually, this illustration does use the exact figures that we were using in terms of expenses and modeled rents. So again, it's pretty nearly identical. So you can see, yeah, 16.8%, 101% return. Equity multiplier is 1.01. You multiply that. If you invested $100,000, you'd be getting $101,000 back in profit, cash on cash. Internal rate of return. We don't need to pay too much attention to that right now. And then a quick review on how a property is valuated upon sale. You take your net operating income. So in year 6, which is what we're projecting, it's a 6-year hold. So in year 6, we're saying total rents minus all expenses comes out to a $822,000 and change in net operating income. And how does the appraiser come with the final evaluation? The appraiser takes the cap rate, which is determined by the trailing 12, and he divides the net operating income by the cap rate and outspits the value of the property, and thus everyone's returns. Now again, these are baseline figures. This is just the way we do it. We do worst case scenario. And I was just telling a friend yesterday that I've looked at nearly 30 deals this year. And the reason why I didn't bring them to investors is because there just wasn't enough margin. There was no margin for error. And I'll illustrate with a cap rate example, but you could only go down, not go up. So, what we want to do is we want to land north of these projections, make everyone happy. We want to knock this thing out of the park. But if we hit a base hit, which I think this is a little bit better than base hit if you're doubling your money in 6 years. That's not so bad. But let's try to do better. So let's go through this and see how this deal could turn out to be, I don't know, home run, maybe. All right, so now here are basically your rents over 6 years. You can see that these are projected rents, which again are so conservative, very conservative. You can see that the rent growth we're projecting is actually even less than inflation. Now this is not what we're predicting or expecting. We're just writing this in to be safe, and anything which happens above here will be gravy. For instance, we've underwritten a high amount of vacancy, right? Why have we done that? Well, it's not your ordinary year, right? This is 22% vacancy. Nobody wants 22% vacancy. Nobody is expecting that. But here we are. It's COVID, the election year. I don't think that really plays a role, but COVID is the big culprit. So we have to be safe, and we have to write in a lot of margin in here just to protect everyone's money year 1. And as you can see, year 2, still 15%. Now the market vacancy, the vacancy for this submarket that Magnolia Park is in, is around 7%. So 22%, compare 22% to 7%. I actually want to say it's 6%. 15%. In year 3, we're still at 12%. We're not expecting that, but we've written this in to protect everyone's capital. And then it's 10%, which is still quite a bit higher than the market average vacancy. So I'm going to show you when we change some of these figures what happens on exit. And this will show what will happen to your returns. But let's just start by saying, let's say year 3, rent growth, annual rent escalator over here, is 3%, which is probably right in line with inflation or maybe a touch above. Let's go to our returns. Hey, look at that. We've already gone from 16% to 20% average annual return. And equity multiplier, your total return has gone from 101%. You basically just multiply this by 100% or by 100, and that gives you your total return. So it's gone from 101% to 123%. Already, things are looking pretty sweet. All right, let's go back to P&L. And by the way, maybe some of you are wondering, how do we get all these numbers? Do we just, guess off the top of our head? No, of course not. Our underwriter has a good idea of what the market has in terms of a per unit cost. He'll write these in initially. Then we verify these numbers with SDMC, who is our professional property management. They know this market inside and out. They verify our numbers. If things look off, then they change them prior to our final underwriting. And as you can see, these guys manage 4,100 units. They own this building, which says a lot. They not only manage a building 1.6 miles away, but they actually own this building. So I've mentioned that before. That shows an extreme amount of confidence in this area by them. They're highly competent, and they are the ones who are coming up with those numbers that you see in our underwriting. So let's go back. Hopefully I can find the right one. Okay, getting back to our model. Now let's say it's not 14% that year. Let's say, 22%. Let's just knock this down to 7, so a total of 15% vacancy. And then maybe year 2, things aren't looking so bad. Take that out just to, actually we'll leave that in. Leave that 4% vacancy. Knock down your physical vacancy to 6, so we're right at 10%. And then this will go 9%. And then from there on out, let's take that 1%. And we'll just be 10% vacancy, which is still pretty conservative. Let's look at our returns now. And, incrementally things came up still a bit. We're up now, we're at 21%. And we've gone from 123 to 127%. And if you look back on the P&L, again, these rents are, we're not asking a lot. This number right here, 737, that's today's market rent. We're just saying bare minimum, if we achieve today's market rents in year 3, we're still going to have some pretty good returns for you guys. But let's say, we're going to try, of course, we're going to test market a little higher. Let's say 690. And then let's just change this to 750. Let's not get too crazy. Say this is 785. We'll just leave everything else the same. Let's go to our exit. Wow. Okay. Now things are getting pretty serious. 163% return. That's nuts. And I don't want to get people's hopes up. I'm just showing you the ceiling. Why this deal has upside, whereas many of the deals that I've gone over, they have 0 upside. And I'm going to show you an example. You can see our net operating incomes come up because of all the changes that we're hoping to achieve. Here's another big parameter or metric that you want to pay close attention to is that exit cap. This is all prognostication, so you have to be conservative. Today's market cap is around 6%. We've built in a full percentage point or 100 basis points higher than today's market cap. Most conservative underwriters will tell you a 0.5 percentage point, or actually 0.1% per year of the hold. So in this case, 6-year, if you're really conservative, you'd write in 6.6%, right? 0.1 times every year of the hold. So 0.6%. I'm going to write that in a second, but I just want to say something. I've seen a lot of deals where the exit cap is either at today's exit cap or even less. And that's scary. I would never bring that in front of investors because who knows what cap rates are going to be in 6 years. So, there's a big feeling that cap rates are actually going to go down. That's a good thing. The lower this cap rate, the higher your return. Because remember, the cap rate is the divider. So the lower the divider, the higher your output, right? 4 divided by 1 is 4, right? 4 divided by 2 is only 2. So it's the same principle. So yes, I've seen a lot of, I was just looking at a deal a couple weeks ago. The market cap was 5.7%, and their exit cap was a hair over 5%. It was actually below the cap rate, and that's a known, the market cap rate, today's market cap rate, and that is a big no-no. So we've been very conservative here, written in 7, again, just to protect everybody's capital. But let's just say we do the conservative rule of thumb and add 0.1% times the year of the hold. That becomes 6.6. And again, now we're approaching 30% annual return, 180% total return. And you can see the cash on cash coming pretty attractive. I'm just giving you guys the potential of this deal. There's a lot of, shiny nickels out there. I was looking at another deal in Orlando with fountains and pools, but the numbers were very aggressively underwritten. All kinds of rent growth. It looked like underwriting on any other year. And this is not a normal year, let's be honest. This is an unusual year, but we have a healthy amount of reserves. We have the long-term debt in place. We're in safe waters on this investment. And as you can see, there's some potential here. So I hope that makes sense. I know I was going over all these spreadsheets and whatnot, but we underwrite the doom and gloom scenario. We write the worst case scenario. So I hope that makes sense. I hope you got a lot out of it. And by all means, you guys fire me off questions via email. I feel like I don't get enough questions from you if you're not understanding things. But yeah, I did have someone think that these are the actual rents that we are expecting. And that's not the case. We just write these numbers in to be safe with it, for everyone involved. All right. Hope you got a lot out of that. This is Rick, Fortress Federation, signing off. Thanks, guys.